Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings, everyone. Jake Bernstein. It is the 15th of October at 12:03 p.m. in Santa Cruz Mountains, California. Regardless of the voice, I'm going to continue and share with you my thoughts today. I had originally planned on doing a 55-year retrospective on my trading with cycles, but I realized very early in the process that it's impossible for me to do that. I don't know what made me think about that to begin with. To share with you everything I've experienced with cycles over half a century is not doable in a 45-minute video, but rather in a series, which is what I'm going to do. So today we're going to talk about the seasonal decision-making process. And first, let me say this. When it comes to cycles, I'm strictly pragmatic. I'm not impressed by cycles. I'm not impressed by the fact that they exist. It's no surprise. If the Earth has a rotation of 365 days, if there's a 22,000-year precessional water wobble, if the planets have cycles, if there are cycles in the births and deaths of animals and tree rings and so forth, why should it be a surprise that there be cycles in economics and statistics and so forth? No surprise at all. So my application of cycles, as boring as it may sound, as simply as unromantic as it may sound, is purely pragmatic, absolutely prosaic. So if there's a cycle, I want to know how to use it, but first I have to find it. So let me share a few things with you. Example. This is a chart of palladium futures going back to the 2012 time frame. It shows a cycle, which is not perfect. We know that cycles bottom late, top late, and so forth, but certainly a repetitive pattern of sorts. What fascinates me about this pattern is the combination of this pattern with human behavior, for example. At the bottom of the screen, I have small trader market sentiment. When small trader sentiment is very high, so for example, this red line shows 80% of the small traders who are assessed or surveyed for this report have been bullish or bearish. So at the top of the chart, the small trader is very bullish. At the bottom of the chart, the small trader is very bearish. And there's an inverse relationship. As an example, let me show you. I'm going to go to this point right over here and put in a little line. You'll notice that the bullish sentiment of the small trader precedes a significant top in price. And right over here, we have a very low sentiment reading, which I'll put on the screen for you, which precedes a bottom. I can go to this price right over here and do the same thing. As I said, it's not perfect, but you can see that it's a leading indicator. It leads over here as well. Let me show you. And it leads over here as well. I'm going to show you again. And here's another one, a major one right over here. One moment, please. And here's one before a bottom, and actually may correlate with the bottom. Let's see. There we go. And here's another one right over here. And I find this particularly fascinating from an investment standpoint, that the small trader is a leading indicator of lows and highs. But let's add something to the picture. Let me remove all of these so we don't get clutter. So here we go. From this point here to this point here, we see a green shading. And this green shading represents the Commitment of Traders report, a report issued by the US government every week showing three groups of traders: small traders, large traders, and commercials. Commercials being the group that basically runs the markets. They're the actual producers and users who have the greatest weight in determining where a market's going to go. And you can see that when the number is green, commercials are buying. So technically speaking, commercials began buying palladium futures here and bought it all the way here, and even to now continue their buying most likely in anticipation of this cyclical low. And from this level, the ideal cyclical low, the market has moved up significantly, not nearly to match the price of gold in terms of new highs, but it's certainly on its way. As another example, I look at something like this. British pound versus the US dollar. And here's the British pound versus the US dollar, showing two cycles, in fact, a cycle and a sub-cycle, as well as the commitment of traders. And you notice that this cyclical length from here to here is almost exactly the same in every case. Again, not perfect, but that's what I find fascinating. Yet in addition to that, we have to make everyday decisions. You can be a cycles fan. In other words, you enjoy cycles just as a concept. You can be a cycles practitioner. In other words, practice the use of cycles in trading and investing, which is what I do. Or you can be somewhere in between. But regardless of where you are, at some point you need to make a decision. I'm going to switch screens now and show you something else in terms of the decision-making process. So bear with me, please. Let's take a look at something we've seen many times before. Seasonal charts right over here. I'm going to go to US futures charts, just one moment. And let's go to the S&P. I want to show you how to make decisions the intelligent way, as opposed to simply taking a guess or making an evaluation. So here we go. S&P futures. Certainly we could look at any market we wanted to, but right now we're going to look at S&P, like so. The question is, what does the futures market do during this period of time? And I want to answer that question as specifically as possible. So here we go. October, November, December. So here's where we are now. Here's this in November and December. I want to answer the question. Number one, what has been the tendency of S&P futures in October, November, December? And clearly, based on what we see on the chart, and this is a composite chart, which I'll explain in detail momentarily. The chart says October, November, and December have been up months, the market usually reaching a peak in early January. This is a composite chart which I've shown in the past. I've taken every March S&P futures contract from 1982 to 2025, and I've made one chart that shows the typical year. We did that mathematically by taking the high of each year, making it 100, the low of each year, making it 0. So we have a normalized chart, which, as I've said before, shows what I think is the DNA, the so-called DNA of the market. But within the context of this seasonal up move, I want to dissect it because I need to make some decisions. If I'm a cycles enthusiast, I can look at this and say, wow, that is an interesting chart. It's very romantic. It's got a very repetitive pattern to it. Isn't nature a wonderful thing? Well, I can say that, but I can also say, when do I get in? When do I get out? That you research this a little bit further, take advantage of this seasonal cycle to make some money so I could fund some more seasonal research or donate to the foundation. Why not do that? So I can do this in a different way. I can go to a different search. Let me show you what I mean. So I can do this for every market, but most important, I'm going to go to seasonal trades and show you the decision-making process. Show you what I mean. I'm going to ask a specific question. Remember, we're getting into considerable detail here, so we can do this in very significant, specific ways, because ultimately, think about this. You need to make a decision. If you make a decision, get information. More information you have, more difficult the decision is going to be. So we need to make a specific request and look at specific details. I'm going to ask the questions. October, November, December. I'm going to ask the computer to show me the seasonal trade that takes advantage of the chart I just showed you in the most logical risk-free way. I shouldn't say risk-free, but limited risk. So my first criteria is this. I'm not interested in trading anything that's been right less than 75% of the time. I'm not interested in trading anything that requires me to risk more than 5% of my capital. So that's a very generous allowance there. Furthermore, I know this. I'm a short-term trader. If I was a longer-term trader, I'd be asking a question differently. So because I'm a short-term trader, I'm interested in trades that have been less than a certain number of days in length. And for me, that's 25 days. That's where I do my best work, within the range of 25 days. I could ask the question in terms of 5 days, 10 days, 30 days, 40 days, 80 days, whatever I want. But remember this, the questions that I ask the computer will be related to the answers that I get. Or putting it another way, the answers that I get will be a function of the questions that I ask. If I ask an absurd question, I will get an absurd answer. So I'm asking a reasonable, logical question, which is, show me any price patterns or cycles, if you will, that have been right in S&P futures in October, November, December to the tune of 75% accuracy with a risk of no more than 5% and 25 days duration. And remember, as you know, since you're not a novice, this is not 100% accuracy. It's subject to losses as well as profits because otherwise this would be 100%, not 75%. So it's not perfect, but it's a step in the right direction, in the direction of granularity. I want to see detail because after all, remember, as a trader, my interest is in details. I don't want the general statement, yeah, the market usually goes up at the end of the year, or yeah, it's the end of the year rally. I want to know buy or sell, exact date, time of day, risk, reward, results, history, everything that I can possibly know to make my decision more correct, by which I mean more profitable. So in conducting the search, as I said before, the answers I get will be a function of the questions that I ask. So let's do this. I'm going to do a search. If there is an answer to the question, the computer will find it. If there's no answer, the computer will say, I don't know. And here's what we get. Example. Computer says that buying March S&P futures right over here, long position, end of day, November 2nd, with an exit November the 16th. And remember, I'm sorry, the 6th. It's a 4-day trade. So we got what we asked for. We asked for a short-term duration. We got that with a risk of 1.5% stop loss of the entry price. Is that a profit to loss ratio of 14.6 to 1? Meaning what? Meaning that in sum total, the winners have been 14 times larger than the losers, which is very impressive, especially when you consider that this procedure has been right almost 90% of the time in the years that are covered. Now remember, I don't need to remind you, but I'm going to remind you anyway. 89.3% is not 100%. It is what it is. It's going to be wrong sometimes. But what else can we know about this trade? When it's wrong, it's at an average loss of 22 points. When it's right, it's at an average profit of 39.48%. So you can see the sum total winning has been much more significant than the losing. So not only does it have high accuracy on its side, but it also has a high PL ratio. And let me show you the history, which is again something that most people can't do because they don't have the historical database. But we have it, and here it is. So let's evaluate. Here's the history of 28 years, and here's the results year by year. So, would you say that it's impressive? I certainly would. Would you say that last year, shown right over here, it had its largest ever profitable trade? Quite impressive. Especially so since all the way back here, it's had basically winners or small losers every year consecutively. What's even more impressive to me is this. I've been showing this trade in all my seminars and webinars for many years, and nothing has changed. The fact that thousands of people around the world, if not millions of people around the world, know this seasonal tendency has not changed it. In terms of the cumulative results, it looks like this. Now, what might you conclude? You might look at it and say, it's been doing too well. It's due to correct. It's going to go down. I can't do it this year. What else could you do? You could say, the geopolitical situation is such that everything is tenuous. The world is on the brink of destruction. Russia is threatening to use nuclear weapons. Korea is threatening to use nuclear weapons. There is no way this can work. I take you back to last year. Was the situation last year any better than it is now? In fact, some people might say it was worse. Has the geopolitical or economic situation been significantly different in all these years? No. And yet, the trade has continued to work. But we need to make some decisions. Let's go ahead and make some. Let's go back to the previous trade. One moment, please. Let's say that I was interested in more profitability. In other words, a larger average profit. I could sort like so and get a much larger average profit, as you can see. That much larger average profit still, 4-to-1 ratio, requires a longer holding period and an earlier starting period. And that result would look like this. Still showing very significant gains, but in terms of the equity curve, not nearly as beautiful. So the choice is yours. My goal here is to tell you how to make that choice. I'll show you. Let's go back. Screen. As a trader, to determine what's most important to me. For me, limiting losses is the most important thing. I want the smallest possible loss because I am, after all, a risk manager as opposed to a trader. So if someone asks me, what do you do for a living, Jake? I say, I am a risk manager. I manage risk. I'm not a trader per se, although I trade. I manage my risk as a trader. So what I'm going to do is I'm going to sort this in a different way. I'm willing to sacrifice accuracy for smaller losses. So here's the average percent loss right here. I'm going to sort this column for the smallest risk loss, and that's right over here. So this is the smallest percent loss, my lowest risk trade, and here are the results. Again, buying October 25th end of day, selling November the 6th end of day with a 4% stop. How does that look? And remember, it may not look as pretty, but in terms of its history, it's got the smallest average loss, which is beautiful for my particular purposes. So let's take a look. And again, remember, I'm showing you a process. It's prosaic, but it is not intended to suit most people in terms of average profit per trade. It suits me because I'm interested in keeping my losses as small as possible. Because if I'm keeping my losses small, I live to trade another day. So here's the results. Let's look. Obviously not as beautiful a pattern, but still very, very, very significant. It shows growth, shows the last 2 years as very wonderful years in terms of profits. And so this would be my trade. And I'm willing to sacrifice, let's go back and look. I'm willing to sacrifice percentage accuracy for small average loss. Let's go back one screen, just one moment, please. Now let's say that you are more interested in the largest average profit per trade. Very simple. You just go ahead and sort for average profit, like so. Get the largest one here, 88.89, with an accuracy of 75%. And that's the trade from the 27th of October to the 17th of November. But you'll notice it has 3 consecutive losses. That does not make me happy because most traders, including myself, aren't willing to tolerate 3 consecutive losses. We want results and we want them to be good consistently. But let's look at the history. Like so. Here's the history with accuracy of 75%. Let's look at the equity. It certainly has had stellar performance since all the way back here and continues to work. So I respectfully submit to you this. The probability is this trade will work again this year. No guarantees. You can improve the results by using a timing trigger. In other words, on the entry date, asking the question, is the trend of the market up consistent with what it should be, or is the trend of the market down? If the trend of the market is down, you can opt to wait until the trend turns higher and the seasonal begins to take hold. Let's go back and do one more thing, and then you'll be rid of me, or you'll have to tolerate me for just a little longer. So let's go back here, like so, and ask one final question. That question is this. Does this trade take into consideration the seasonal tendency that we looked at before? Let's look. Here's a seasonal chart, which shows this particular trade from start to end. And the period in yellow illustrates the time that we're in this trade. Here we go. So this is it right here. Very valuable tool. Let me show you the answer to an important question. This is the trade. And these are the results at the bottom of the screen. The question is, what happens to this trade after the season is over, which is where the yellow ends? You'll notice it keeps on going. What does that mean? It means that if the trade is profitable on the exit date, the probability is that it will continue higher in your favor and you can keep the trade longer. It's a very important part of what we do. So not only did we show you what to trade, when to get in, when to get out, the risk, the exact date of entry, the exact time of day, as well as what to do in terms of timing in the event that the trade is not moving in the right direction. We can do this for any market we want in the futures. Very easy to do. And let me give you a shameless self-promotion. If you're interested in what I do, go to my website, jakebernstein.com, and register for the 2026 forecast, because the 2026 forecast will give you a specific idea of what I expect and how right it's been in terms of the overall tendencies. Another thing you might want to do is this. Look at the forecast that I made last year, especially here at the foundation, and see how things turned out. But if you're interested in my forecast for 2026, feel free to take the discount customer price since you're a member of the foundation or you're here at the foundation reports and webinar. Let's go back and do one more thing. Go back to the previous screen and show you a different way to sort entirely. Let's say that you have no interest whatsoever in minimizing the loss. You're willing to take whatever comes your way. Let's say that you're a trader who's more interested in accuracy. That's easy to do. Just go to percent wins, like so. Sort for percent wins. This is your highest winning trade here at 92.9%. November 2nd to November the 5th, just 4 days, just 4 days. And here are the results. And you'll notice this trade has never lost twice in a row, which is what makes many people happy. But I'm not necessarily in that camp. I'm more interested in managing risk. So let's look at the history of this trade. And again, I apologize for the lack of voice. In case you didn't know it, it comes with age as well as allergies. So let's take a look at the results. Largest win ever last year, the year before. Let's look. Here's the trade. And in terms of consistency, very consistent trade. So let's review what I told you before. Number one, I showed you some cycles. I indicated that I'm not a cycles purist. I don't believe that cycles have to top or bottom exactly the same way all the time, and therefore I use cycles with timing. Number two, I showed you a seasonal trade that's coming up in the S&P futures and how to make the decision in terms of history, in terms of statistics, how to make the decision that's right for you, depending on where you find yourself on the curve. In other words, are you willing to sacrifice accuracy for profitability? Are you willing to sacrifice profitability for accuracy? Are you interested in keeping risk small? Or are you willing to take more risk for more accuracy and more profit? So that depends on you. Very significant. Another thing I would say to you is this: go for granularity. If you're a cycles fanatic and you're a purist, you're going to look at things and you're going to say, this is incredible, it's wonderful, it's beautiful. But I'm going to say, that's all well and good. But how do I use it? How do I use it in a pragmatic approach in terms of prosaic application of the rules? That's the most important thing for me. So I wanted to share that with you and give you an opportunity to see how things work out ahead of time. No guarantees, of course, because the future is not perfect. We do the best we can. So again, I invite you to attend my annual forecast. You can look at the details at my website, jakebernstein.com. Or if you want to ask more questions, you can send them to the foundation or to my trade-futures, jake@trade-futures.com email address, and I'll be glad to answer your questions. So folks, that's all I have for you today. Hopefully we can get started in a series of my experiences over 55 years of trading, if I can still have a voice by then. Thank you very much, everyone at the foundation, for giving me the opportunity and for your great work.